Picture this. You're running a mainland trading company right here in the UAE. You're bringing in millions in revenue. You're expanding your footprint across the MENA region, and honestly, business is booming. Now, you've just closed your books for the year, and under standard corporate tax rules, you'd be bracing yourself for a 9% charge on taxable income above 375,000 dirhams, right? But instead, you are legally paying exactly zero corporate tax. No catch. So, how is that even possible? Well, it's all thanks to a newly extended government rule known as small business relief. Welcome to this explainer where we're going to unpack exactly how this all works.
Literally 0 dirhams. That is the actual corporate tax liability for eligible businesses right now. And here's the crazy part. This window has just been extended all the way to 2029. By treating your taxable income as zero for the period, your compliance basically collapses down into a simplified return. But far more importantly, all that cash that would have been drained by taxes, it stays right where it belongs, inside your business. You can use it to buy more inventory, secure freight contracts, or just push forward with your market expansion. For your working capital, this is absolutely a game changer. Okay, here's our roadmap for today. We're covering 1, the zero tax opportunity. 2, rules of the relief. 3, the trading margin trap. 4, banking and compliance trade-offs. 5, structuring your supply chain. And finally, 6, VAT, customs, and beyond. Let's dive in. Starting off with sections 1 and 2, the zero tax opportunity and the rules of the relief. So, the UAE Ministry of Finance recently issued Ministerial Decision No. 131. This officially extends the relief to tax periods ending on or before December 31st, 2029. But you have to look at how eligibility is actually measured. Let's compare two businesses. On one side, you have a high-margin consultancy generating 3.1 million dirhams in revenue. On the other, a low-margin trader turning over 2.9 million. The consultancy, totally disqualified. The trader, fully eligible. Why is that? Because top-line revenue and literally nothing else is the absolute sole metric for eligibility here. It doesn't matter how much profit you take home at the end of the day, the government is only looking at that gross top-line number. To actually claim this relief, you've got to meet 4 specific requirements all at the exact same time. First, you must be a resident person for corporate tax purposes. Second, your revenue in the current tax period absolutely cannot exceed 3 million dirhams. Third, your revenue in every previous tax period must also have stayed at or below that 3 million mark. And fourth, you can't fall into the explicit exclusions. That means qualifying free zone persons who, already get a 0% rate are excluded. And constituent entities of large multinationals, meaning groups with revenues over 3.15 billion dirhams, are strictly barred from this. Moving on to Section 3, the trading margin trap. This is where you really need to be careful. This is where things get genuinely dangerous, especially if you're a general trading entity or a B2B order fulfillment operator. Let's break down a very real, practical scenario. Imagine you're a physical commodity distributor. You work on razor-thin margins, say a 3% net margin. You move just 2 or 3 high-value bulk container shipments, and boom, you generate 3.1 million dirhams in gross revenue. Now, your actual net profit is tiny, under 95,000 dirhams. But because the rules only care about gross top-line turnover, you've accidentally breached the ceiling. Your relief status is lost. You are now forced into full 9% corporate tax compliance and transfer pricing obligations, all for making barely any actual profit. And here is the real kicker. Permanently unavailable. Once you breach that 3 million dirham threshold in any single period, the relief is gone for good. The door closes permanently for all subsequent periods. So even if your revenue drops completely off a cliff the very next year, it doesn't matter. A one-time spike completely disqualifies your entity forever. You have to monitor your top-line revenue like a hawk. Section 4, banking and compliance trade-offs. Let's look at the flip side of this coin. Electing this relief obviously gives you a massive immediate cash flow advantage. But filing a return showing zero taxable income doesn't just happen in a vacuum. You have to weigh the immediate benefits against real-world operational realities. Yes, you get those sweet tax savings with a simplified return, but you're trading that against potential credit risk. You see, banks do annual account maintenance reviews. If your tax filings show zero taxable income, but your bank account is showing heavy turnover, that is a huge red flag. It triggers KYC and AML compliance inquiries. Plus, if you rely on trade finance, securing letters of credit or supplier credit limits almost always requires showing clear, auditable profitability to your lenders. This is exactly why you must check your specific jurisdiction and banking covenants before you just decide to opt out of annual audits. Look, the tax authority might not ask you for audited financial statements for this simplified return, but your bank or your specific free zone licensing authority, they very well might. Traders planning to actually use trade finance simply have to maintain full management accounts and audited financials to keep their banking partners happy, regardless of what the tax rules say. Okay, Section 5, Structuring Your Supply Chain. Let's talk strategy. Since the thresholds are measured strictly against gross revenue, regional supply chain operators need to get smart. They need strategic solutions. So ask yourself, how do you protect your 3 million dirham thresholds? You have to actively evaluate your order structures, how you handle contract handovers, and exactly what role you're playing in every transaction. You need to structure things so they accurately reflect your operations without artificially inflating your top-line revenue and crossing that fatal limit.
The fix here often lies in your commercial model. Think about a principal versus agency structure. If you act as a principal, buying goods at 2.8 million and reselling them at 3.1 million, you recognize the full 3.1 million as top-line turnover, and you permanently lose your relief. Ouch. But if you operate under a disclosed commission agency model, where you just facilitate the trade for, let's say, a 5% fee, well, then only that net commission, 155,000 dirhams, counts towards your top line. That single smart shift in commercial contracting preserves your zero tax relief straight through 2029.
Section 6, VAT, Customs, and Beyond. Because it's not just about corporate tax.
We absolutely need to clear up a common and honestly incredibly costly misconception. Corporate tax is just one piece of the UAE's regulatory puzzle. Let's make a hard distinction right now. Electing corporate tax small business relief grants you zero, and I mean absolutely zero exemption from VAT or customs obligations. The mandatory VAT registration threshold remains exactly where it is, at 375,000 dirhams. You still have to register, issue tax invoices, and submit those periodic returns. Same goes for customs. Import and export duties, inspection clearances, cargo declarations, they are all fully enforceable. If you mess up your VAT and customs compliance, you will get hit with severe statutory penalties.
So, how do we actually put this into practice? To claim the relief, you have to actively elect it on your corporate tax return through the Emira Tax platform. It does not happen automatically. You've got to confirm your revenue history never breached the threshold, maintain all your underlying accounting records because the FTA can absolutely request them, and ensure you file that simplified return by the deadline. Keep in mind, even if your tax payable is zero, filing late still attracts some seriously heavy financial penalties. Now, to manage all this without losing your mind, especially if you're a multi-entity regional group, consistent tracking is non-negotiable. Utilizing digital B2B trade infrastructure like platform Tendify Net can be a lifesaver. It helps you maintain the clean, auditable transaction-level data you need. These platforms pull together commercial data from suppliers and freight forwarders to keep your contract trails totally organized. That is absolutely critical for keeping commercial control, and it acts as your operational backbone if you ever have to defend yourself in an FTA audit. Ultimately, the extension of this relief is a massive, massive opportunity, but it requires disciplined tracking from day one. You want to ensure that any structural adjustments you make, like shifting to an agency model or upgrading your digital tracking, are executed with smart, long-term commercial timing, not just as some desperate last-minute tax reaction. So I'll leave you with this to think about. Is your supply chain currently structured to not just survive, but truly thrive all the way to 2029?